Hi, my name is Deon Rebello, and this is the Bullion Vault. Hi, Willem, how you doing?
Well, in yourself, thanks, Deon.
I'm very good, thank you. So we're on episode 42. There's been a bit of a gap between the last episode we did, and interesting enough, a lot's happened in the precious metals sector. So yeah, I mean, if we look at the pricing right now, just quickly, gold's at 4,120 odd dollars an ounce. Silver is at $51.67 an ounce, and platinum is at $1,583 an ounce. So when we last reviewed it, gold was around 4,000 and about 39, $4,040 an ounce, and silver was quite down. It was $47.60. Your thoughts?
Yeah, I mean, yeah, we've seen the quite a decline from the highs that they were enjoying just a few weeks ago. Um, but as we've always been saying, there has to be that correction sometime, and the fact that silver is already over $51 again, gold is already sitting at $4,120. It's just a sign that they're not really done yet, isn't it?
If we look at in our last episode, and we discussed the pullback on both gold and silver, and all the precious metals. At the time, uh, if I remember, we were quite clear that this was a time to actually look at buying. We did see it as a short-term period of time, and we would see it ramping back up. It's interesting that it's actually ramped up so quickly and got back online to where, especially silver, to where it's now marching towards $55 an ounce.
Definitely, yeah, and there's quite a bit we're going to discuss on silver just now. But there's this retraction. According to Richard Fisher, one of the former Fed advisors, he says it's more than just a case of profit taking. It's not just about people seeing a record high and selling off their gold and silver. This is actually something that speaks more towards severe strain on the financial system. We've got banks reporting private credit stress after recent bankruptcies. We've got consumer debt at record highs. Credit card delinquencies are climbing, and this is more about just making a profit. This is about selling off financial assets to actually gain liquidity and turn those assets into a source of cash. So it's more about the actual state of the financial um, system at the moment than just taking in a few profits.
And again, I know we're going to unpack silver quite with quite a bit of information today, but it's something I do want to also touch on, and we're going to speak just towards the end is about the markets, the overvalued, as far as the S&P 500, which is a good barometer of the US, stock market. Again, it is seriously overvalued, and what it's leaning towards, and also interesting enough, old Robert Kiyosaki came out saying that old Warren Buffett, for many, many years was very anti-gold. I know that in previous years or previous decades, Warren did buy into silver in the 70s and then again in the 90s and then in the 2000s. He bought them over periods of time and then he'd then sell on. And a lot of his response to that was he was buying as a hedge, and then once through a certain period, he'd then liquidate that. And a lot of the time, there was this belief that it was actually short. It was a premature pulling out of that market. But what's interesting is he was never a fan of gold. And now suddenly he's calling it, and Robert Kiyosaki through X had a big go at him to the extent, I mean, he starts the whole X thing with, I'd like to vomit, and then he expands further that saying, here's a guy that has always been against precious metals, has never ever seen the value in them, and now suddenly saying that there's value. And what Robert really is trying to highlight here is that this is more an indication that and we speak about this always, is as soon as your mainstream investments or mainstream media or mainstream people start to actually see value in what was deemed an alternative product, suddenly it becomes mainstream. That's a massive awareness phase. And of course, we see an acceleration in prices. But what it does underlie is, and you've highlighted it earlier, that the economies globally are in trouble.
Yeah, and I mean, if we just take a look at Buffett on silver, as you rightly mentioned, he has been very much against gold for a long, long time. And if you look at the times that he's actually bought silver, it's when the gold silver ratio was extremely high, and when the demand versus the supply, when there was a deficit in the silver supply, he bought 111 million ounces. I'm
Yeah.
sounding like a former ex-president now. He bought 111 million ounces in 1997 when there was a massive, I think it was a deficit of about 100 million ounces a year at that
Yes.
stage.
Yeah.
And then, now this is the other thing, he held on to it for 9 years and he sold it in 2006 and he made $97 million profit on that sale.
Yeah.
So the big thing is, and I think this is why we're seeing silver bounce back so rapidly. I mean, gold is gold. It is the safe haven asset. Every time something happens somewhere, Russia sneezes, America coughs, people rush to buy gold.
Absolutely. Yeah.
And but silver is different in that 50% of its consumption or its demand actually goes into industrial consumption.
Yeah.
And if we look at over the last few years, 2024 was 680.5 million ounces of demand. In 2003, it was 657 million ounces. And in 2022, it was 592. So we're seeing a ramp up in the demand for silver.
Yeah.
And most of that is coming from industrial uses. We're seeing a rise in things like AI, which use silver for its semiconductors. We're
Yeah.
seeing a massive demand from the renewables industry, which is your solar panels and electric cars. And this is what has helped push silver to this massive demand. And on the other flip side of that is silver is a byproduct in the mining of copper, tin, zinc, all of those things,
Yeah.
which creates the problem that there's no gold silver production tap that you can just turn on and off.
Yeah.
And that's the reason why we're seeing these deficits in the silver supply. And that is why we're seeing a much more stable and a much more higher silver price overall.
Yeah, and again, if you look at the performance of silver over the last couple of years, we've always spoken about it that in previous years, like around 2020 and prior to that, silver would spike to a certain high and then it would drop to quite a large level in percentage. So it was very erratic. Gold, we always likened to a marathon runner, which was slow and always moving upward. A little drop, a little climb, little drop, and then slowly moving upward. Silver was very erratic, and I mean, we likened it to an ADHD child. And it had those characteristics where it was up, then it was down, then it was up, then it was lateral, then it was, and all of this. Now suddenly we come to around late 2022 into 2023, and then slowly we started to see the prices starting to stabilize. There'd be an increase, a small little drop, but then there'd be that next increase a little bit higher, and that whole trend carried through, where silver in 2023 had an unbelievable year as far as growth, and then again in 2024. And again, this is speaks to this year where we saw silver start quite slow in relation to gold from the beginning of the year, but it's just become strong in its growth. And even this last pullback, where it pulled down to $47 from, I think it was about a 53, $54 mark, where it actually pulled down significantly. And people said, oh, there we go, it's back onto its old way of being. And then suddenly it just pulled back up to 50 and then stayed there for a little bit, and it's now starting to do that and climb back up to its original high.
Yeah, and it's interesting. I mean, I think I was preparing a document for one of our clients yesterday, and I was calculating the year-to-date growth of gold and silver, and gold was around about your 52, 53%, I think it was, and then silver you see 73%. I
Yeah.
mean, it's really crazy. And the scary thing is we still haven't, it's still not sitting back up to its all-time high right now. And especially if you adjust for inflation, it's absolutely nowhere near that. And I think that's one of the things we'll go into when we talk about the um, old Mike Maloney's one of his new videos, which is some very interesting content in there.
So I think let's actually jump straight into that because there's some stuff that I wanted to chat on about the S&P 500, but we'll finish off with that. So as you mentioned, and for me, when I saw the video, I thought, oh, we got to talk about this. There's a lot of information that, and I like the way he does unpack it. His message is very clear, and it's geared up for people that are not necessarily involved in markets or in equities or anything like that, and he kind of gives you a good understanding of a scenario. For many years, he's called that silver and gold would do the growth that they're doing. He also has called for that there's some market reset slash recession slash depression on the cards, and we'll finish off with that. But let's unpack that whole Mike Maloney video.
So yeah, you mentioned the monetary reset, which is already underway, and pretty much what they say is silver could be one of the biggest beneficiaries of this, um, and if we're looking at actual physical demand at the moment, which is what we just spoke about in terms of your AI, your industrial applications, the demand coming from there, the global demand right now is overpowering what the paper markets can actually deliver. You can't build a car with paper. Let's just say that.
Yeah. Now, again, and this is what you kind of highlighting, and I was going to say it is we must remember that even though silver is categorized as an investment metal like gold, it has massive industrial applications. In fact, second to oil, it is the most used commodity on the planet. As we've said many times, it has the highest heat and electrical conductivity, so it's used in solar panels, which is a massive market for silver's growth. We look at the the electrical market as far as electric vehicles. That's also a massive market because it's used in all electronics. We look at it; it's used in dentistry, in medical applications, in mirrors. Literally, you name an electrical device, it will have some silver in it.
Yeah, and that's the thing. The paper trade can only suppress that demand for so long. At some point, you need that physical silver in your hand to produce something. And, as Maloney puts it, there comes a point where the paper game can't continue overwhelming the real market. And this is the thing, we have this global divergence between paper and physical markets. And it's a sign that trust in fiat currencies is eroding and that investors worldwide are moving towards these more tangible assets.
Yeah, and again, you can see that because we look at even with the rand dollar right now, it's sitting around 17 rand 15. And I did a look back, and I mean, from its peak where it was just over, I think it was about 19 rand 60, it was very high, and that was around 2023 when it had that massive peak. And from that period of time, it's now pulled back down to around 17 rand 15, which it's its lowest in a very long time. That said, it's got nothing to do with our market. It's got nothing to do with the performance of SA Inc. If we were grading SA Inc. In an exam and in terms of output and production and all of that, we'd be proper F failure right now. I mean, with zero growth, our debt to GDP ratio remains high. We still repaying a number of loans. There's a lot of infighting within the national government of unity. We look at municipalities, a lot of them remain insolvent. So South Africa's got a lot of problems. And of course, a lot of economists that are pro government, or not necessarily pro government, but wanting to put a rose tint to the actual economy will say, but look how strong the rand is. We're doing so well, we're performing well. And it's very simple. It's got nothing to do with our economy why the rand's so strong. It's got to do with a very weakened dollar right now.
Definitely, and that's what I was actually going to say, the exact same thing. It has more to do with the global economy than our economy.
Yeah.
The global economy is in a bit of a tight spot at the moment, especially, as you said, the weaker dollar. And one thing you can always look at to see where this is heading is you look at your global reserve banks, you look at your big investors, and the latest IMF data shows that gold accounts for 20% of global reserves, and it's a level that we haven't seen in decades.
Yeah.
You know, um, Another beautiful one that Maloney pulled out here is central banks can print currencies, but they can't print gold. And I think that that's a clear indication that, the strength of gold is a signal that these major institutions are preparing for the same risks that private investors are preparing for: inflation, your debt expansion, fiat currency debasement. And it is the signs that they're putting out there that, you know what, maybe there is a great reset coming. And then we really are going to see the true value of your precious metals.
Well, you say that, and I mean, I read another article where the guy had done a 200-year evaluation of silver. And he was basically saying on the current trajectory that it's on now, that, and again, you must, and it is important that this is information. We do all of our own research, but again, before you ever invest in precious metals, please make sure that you are doing your homework and buy from reputable buyers, well, retailers. But what he was saying, which was quite interesting, is his trajectory based on over the last 200 years is silver should reach around $375 an ounce by 2028. Um, Again, we could say that, sure, that's a stretch from where it is sitting at 50 odd dollars an ounce right now. But we just need to unpack the story of even the beginning of this year with gold, where we saw gold at I think it was around $2,300 an ounce, and thereabout. And now suddenly we're looking at double that, 4,000 odd dollars an ounce. And no predictor, or anyone that was a market commentator on the projection of where the prices of the precious metals would be, not one of them said that gold would be over $4,000 in 2025. It was completely and utterly beyond, to the outliers, the
Yeah,
crazy.
I was about to say it's the nutcase outliers that we usually ignore that were quoting these prices. But there's another thing at play here, and that is the current gold silver ratio.
Yes.
So it's sitting at about 81 to 1. So that means 81 ounces of silver will buy you 1 ounce of gold, and it's still one of the most extreme we've seen in recent history. And if we look back at April, it was over 100, which means silver was very low or very cheap in comparison to the market. But what I was getting at is, previous cycles, because you just mentioned the $300 silver, and previous cycles have seen that ratio go down to 14 to 1.
Yes.
So this means that silver can still outperform gold by as much as 6 times
Its
if
current value. Yeah.
that cycle repeats itself again. And yes, we've had a massive rally this year in the silver price, but it's still far below what it was, especially if we go for an inflation adjusted figure. It's still so far below what it was at its absolute peak. In 1980, it was sitting at $52.50 an ounce.
Yes.
Now this is $1982, $52.50. And if we round that up for inflation, we get roughly about $280 an ounce using the official CPI data. But if we're adjusting for pre-1990 inflation methods, then this figure actually goes up to $1,000. So that 300 is not as far out as you might think it is.
Yeah, again, I thought it was interesting, as the data on this specific article looked over the 200-year period. But again, I think it's important that where we are in the current market, and these are the kind of things that we stress. Is what's been interesting is even for us as a company. I mean, we looking to export silver into Europe because there is based on our pricing, based on what we can supply. And as you say, silver is a byproduct. So a lot of the gold, especially in this country and then also in Zimbabwe, it has a very high silver content. So a lot of the gold, and silver used to be just literally, removed from the gold and cast aside as not worthy of even consideration.
It's the junk that comes with the good stuff.
Exactly.
Yeah.
Now suddenly there's a demand. We know in the States, we know in Europe that the actual demand for silver has been so high from a coin perspective, a numismatic perspective, where people, those markets are very developed within that sector. And a lot of the mints that produce a lot of the numismatic coins and sovereign coins and so on have actually been sold out due to the lack of supply of silver. To the extent it's an opportunity where we are looking to actually export.
Yeah, and I mean, this is the thing we always say, don't look at the short-term swings, look at the long-term potential. And, it's also something that we always urge our clients to do is don't look for the quick win. Remember that this is a marathon, and patience is the thing that's going to get you there. Um, if you sell the moment you see the price starting to drop, then you are obviously going to lose out, because as we've seen this year, I mean, $50 an ounce, 73% year to date growth. It's actually quite insane what it has done over this year. Had you sold 3 or 4 years ago, because you saw the price heading, during COVID, heading towards, what was it, $12 or something ridiculous.
Yeah, so actually, in fact, it was March of 2020 where silver was $12 an ounce.
Yeah, and the point I'm trying to make is, had you sold it when it was sitting at, let's say, $20 an ounce and going down, because you feared this $12 an ounce, you sold all your silver. We're sitting 5 years later and we're looking at $51 an ounce.
Yeah. Again, I always smile and I think of our famous Hershey comparison to a bar of a silver bar, a 10-ounce silver bar or a Hershey bar, and for me, this sector is very much reliant on information, on people like us, like Mike Maloney, talking about precious metals and making it accessible to the man in the street to actually say, listen, there are alternatives to currency devaluation. If you're living in rands and you holding all your assets in rand hedged vehicles, the rand is continuing to devalue to the dollar, to other currencies. Gold, silver have proven over long periods of time to negate those losses. In fact, grow when we have those currency devaluation. You look at inflation, where if inflation continually rises, so the cost of living increases, we see everything getting more expensive. And yet, if we compare gold and silver, they've maintained their pricing. In fact, they've actually got stronger. So if you're holding your assets in gold or silver, you're going to benefit through that over the long period.
Definitely. And the biggest thing is, I think people overestimate how long, let's say, 20 years is.
Yeah.
We remember when Monsters Inc. came out, the movie.
Yes.
And that's more than 20 years ago.
Yeah, I saw something the other day. My son's 22. Well, he's actually going to be 23 now in January. And I thought about it the other day. Like 2003 seems like it literally was yesterday, and yet that is 23 years ago. Coming up to 20, come into when we go into 2026, which we are a month or literally 6 to 7 weeks out from that change of the year, that's 23 years ago. And you think in that period of time what you could have done if you had actually bought precious metals through that period of time.
Well, I'll tell you exactly what you could have done. If we look at the past 20 years, Gold was sitting at $446.75 an ounce in 2005. Now think about that. $446 at 3,113 Rand.
Yeah.
Imagine buying an ounce of gold for 3,000 Rand. Silver was sitting at 51 Rands an ounce. It's absolutely crazy to think about this. Now we look at it, we're sitting at 71,000 Rands for an ounce of gold. We're sitting at 874 Rands for silver. And that is what happens in 20 years. But now on the other side of that, we look at the US dollar versus the Rand, and what we're sitting at currently 17 Rand, 15 round about there, 17 Rand, mid
15, yes.
yeah, round about there. If we look at it, 1 year ago it was sitting at 17.94. So yes, we've seen a bit of a stronger Rand, but once again, it has a lot to do with the weakness of the US dollar as opposed to the strength of the Rand.
100%.
But we go back 20 years, we're sitting at 6 Rand 67. And that's the other flip side of 20 years. Minus 157% on the Rand to dollar exchange rate. And that's where the danger comes in. And that's what we're trying, this is what we're trying to tell people. This is what we need to prepare for. This is what you need to build up, this defense of yours, insure against it. And, as Maloney said in his video, this monetary reset happens gradually, then suddenly.
Yeah.
And by the time you realize it's happening, it's too late.
Yeah.
It's like saying, oh dear, I've just drove my car into a brick wall. I better phone the insurance company and see if I can take out insurance on it. It's way too late.
Yeah. Or everyone thinks, when I start to age, I will start to stop drinking, stop smoking, I'll do all these things, and suddenly they hit 50, then they hit 60, and they're still doing all those things. So again, it's like, that's the thing, is a lot of these things happen with us not even being aware. We get so caught up in the moment that we forget that things are ticking away. And again, from that one client that we've been busy with doing projections for, and what's interesting is we were asked, like, where do you see gold and silver being over the next 6 to 12 to 18 months? And it's a hard question. We could paint it up saying, what, it's done from year to date, it's done 50 odd percent in gold and 70 odd percent in silver. Therefore, that's what's going to happen next year. And to me, that's sensational. Let's be realistic here. So if we had to say, where was silver and gold on average over the last 20 years, what would that number be?
If we look at the gold growth over the last year, it was this now the last 12 months, it's 50.26%, and these figures were done yesterday, obviously, so it might have changed a little bit since then.
Slightly, but
it's difficult to keep up all the way.
Fairly accurate. Yes.
Yeah, and as you rightfully mentioned, it's a difficult question to answer. Where is it going to be? Because we don't have a crystal ball. I don't know. Something could happen tomorrow. It could plunge through the floor. It could go through the roof. There are things that is impossible to predict. And so even if we look at, Goldman Sachs and the like with their forecasts and their predictions for the gold price for this year, they've revised it about 4 or 5 times already. Absolutely. Which means the best in the world, the people who have everything at their disposal. Yeah. For some reason, I can't say that word suddenly. Everything at their disposal. They've got the best models. They have people who are trained, who have been working in the industry for decades. Even they can't tell you with 100% surety.
So let's take a measured approach.
Yeah. So as I was saying, 50% gold growth this year, 57% silver growth now this over the past 12 months. If we look at it over 20 years, we're looking at 2,126% growth on gold. We're looking at 1,550% growth on silver. That's obviously in terms of South African Rand. And that gives us a the compound annual growth rate of 16.93% on gold and 13.23% on silver over the past 20 years.
See, now for me, if you then break it down like that, and that's more realistic. So we taking the highs and lows of a 20-year period. And what's interesting is at around what 15% on both of them, or there and thereabout, that is a good return per annum on an investment. So for me, we can say yes, it could be another 50% growth over the next year, or it could hit $6,000 by the end of the decade, or it could hit over $100 in silver by the end of the decade. The fact is, we know it's going up. And I know you said, it could increase, it could completely bottom out. The fundamentals still show that it is very clear that we're in a boom. In other words, its movements are upward, but realistically, how quick will they move up? And I think, if you're saying around that 13 to 15% per annum, that is realistic. And that's a fair valuation of a projection for the next five years.
Yeah, and if you actually take that figure, if you take that CAGR over the past 20 years and you plug that into what we have now, it actually comes up with some very plausible numbers. We're looking at, in 1 year's time, $4,616 for an ounce of gold, which, I mean, we thought that it was racing towards that this year, and that is actually a very plausible number, let's be honest.
In fact, it's very conservative when you actually put it into the actual monetary value.
And then if we do the same thing for silver, we're looking at $55.94 an ounce, so $56 an ounce, which once again, extremely plausible and probably conservative. If we look at it over 5 years, we're looking at $7,142 for an ounce of gold and $81.6 for an ounce of silver. And, those might seem like a bit more far-fetched numbers, but we're just following the trend here. We're following what it's been doing for the past 20 years. And if we look at the 1-year forecast, it works. The question is it going to work for that 5-year forecast?
Well, I'm prepared to nail my colors to the mast. And again, I think they are conservative projections, but I think they are realistic. They're a good starting point for anyone that's thinking, what should I do? Should I be putting, some exposure into precious metals? There are different vehicles. Of course, there's the physical. There are paper derivatives, but again, you be aware of what you're buying into. But those kind of projections, based on the year we've had, and it hasn't ended. The craziness, both globally, internationally, with the geopolitical flare-ups throughout the year in the different hotspots throughout the world. You look at the economy side, and we're going to finish off with that now, it's not in a great shape. The US economy is not in great shape. And this is what we got to consider, is this isn't going to change. So we can use that as a nice barometer of where it will go. Conservatively, that is realistic.
Yeah, I mean, as you rightly say, where the world is sitting right now, geopolitically, financially, it's a bit of a precarious one, let's just say that. And you 100% right. Those things aren't going to resolve themselves overnight. It might get better, it might get worse. I don't think it's going to swing too much either way, but we're still sitting in a bit of a crunch on all fronts, and that is what's driving the gold silver price at the moment. It's what's driving this aversion against currency and into hard assets like gold and silver.
Absolutely. And I think, just finishing off this episode is, we always look at the S&P 500 as a good barometer of the US economy, the state of the economy. And what is interesting is literally over the last 5 years, it's grown exponentially at over 190% in growth, which for me, a lot of people will say, but that's really a good performance. Let's look at the fundamentals. If we're looking around 2020 with COVID, a lot of those companies were not performing. We're not actually even operational due to COVID, due to lockdowns and so on. And yet they were declaring unprecedented profit margins. Yet that was the funding that was given through the money through quantitative easing during that period of time, and it just hasn't slowed down. So when we talk of bubbles, we know that the US economy is sitting on a massive overvalued bubble right now. And this is what also Mike Maloney had spoken about, is that there is that moment in time where at some point this has to be corrected. And it's clear indication, the fact that the central banks are buying gold, the fact that a guy like Warren Buffett, who, considering he is retiring now and he's been one of the leaders in global investments, never promoted gold, yet he's suddenly turning around and saying, you know what, it has a valid position in the world we're living in. And he's saying that because of the massive uncertainty that we face from an economic perspective globally.
And it's quite significant talking about these bubbles because, people were talking about the gold and the silver bubble and look how high it's rising. Oh, it's a bubble.
And then if it's the biggest fall in 12 years, but let's contextualize that.
So, yeah, I mean, we're looking at some financial fair value models that was done by Tom Bradshaw. And, we're looking at gold, he estimates, is about 17% overvalued, silver 6% overvalued, and then the S&P 500, which he estimates is 169% overvalued. Now, you tell me which one of these is the bubble.
Yeah, and again, what's interesting is both the gold and silver, which he was mentioned being overvalued or biggest drops in one day. The difference is they're still at all-time highs.
That is very true.
So how much of a drop is it in context to how much has grown over the period of time is what's critical here. We can create a sensational headline with any information. It's just how you dress it up.
Definitely. I mean, if you were, let's say 2 or 3 weeks ago, you went on holiday for a nice little holiday somewhere to a remote island, you didn't check your phone or anything, you came back, you'd still look at gold and silver and say, oh, wow, that's gone up nicely.
Yeah, and there would be no hesitation to still see the value in it. And again, we like I've always said, pay attention to the central banks, pay attention to the banks, pay attention to your investment companies and so on. What are they doing? We've seen this whole shift away from, models where it was 60-40 and now suddenly it's 60-20-20 and of that 20% is gold. That was unheard of even 2 years ago, never mind prior to that. Gold was always considered to be an outlier. It was not considered to be a good investment because it didn't give you the returns of, say, stocks within companies and dividends and so on. And yet it's outperformed hands down pretty much everything in the market.
Yeah, it's you don't think of gold as an investment that way. It's not something that's going to pay you dividends each year, etc., etc., which is the reason why a lot of people don't want to invest in gold, especially your big investors. It's probably one of the reasons why Buffett was so averse to it. And usually what we say is it's not that kind of investment. It's something that you invest now, you hold it for a period of time, maybe even for your children, your grandchildren, or whatever the case might be. It's a vehicle to preserve your wealth, to grow it over time slowly, instead of seeing those annual returns fall into your lap.
And what's interesting, a lot of the time, those annual returns, they give you these projections saying, you buy into this, it's going to give you a 10% yield, da, 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 da. And, there's always a small little asterisk there with the small type that says, this is based on markets that do fluctuate, and we cannot guarantee that growth. Even though we're showing you a number that will grow to that, it's a perfect storm. It will happen if this and this and this happens. And a lot of the time, and probably 90% of equities out there within the stock market are under that position, that they sold on the premise that this is what they will give you based on the current market conditions. And then suddenly there's certain factors that change, and then they don't perform. But then they'll remind you, we did say that this is based on markets that fluctuate.
Well, of course, I mean, you're a salesman. You know, you want to give the people what they want to hear, and the easiest way to make a sale is to, and you're not lying when you say it, because that's what the data says right now. And you're going to give them the best case scenario or the current scenario, which looks good. And it's I suppose it's the common thing to do. We of course usually go a bit more conservative on our estimates and the like, but it's not. I wouldn't say it's unscrupulous tactics or anything like that. It's just the way the game is played. And yeah, if you want to see those returns that they promise, things will have to continue going right. And as we all know, they don't always go right.
Yeah, absolutely. And again, I'm happy that you did mention our projections. Again, we could address them up to be far more aggressive. But as I'd said to you, is I want a measured approach to it. We need to see if it is slow. So say next year for gold and silver is a slower year based on 20 years of data, and we can even go further back. And it's consistent that through the different decades, there were decades where commodities were not strong, the 80s, the early 90s, and so on. And even into the 2000s, that initial period, they were not strong. Yet, if we look at it over a 50-year period, they've given a consistent return that was going upward. They're not down. And that's more important here is we got an asset that has performed over the long period. So even over a 20-year period where we're saying it's between 13 to 15% of annual growth, that is very realistic based on the current market position. If not, it would be even more. But we're saying, say things do slow down. Say there's a someone with a crystal ball in the States that can just change the US economy, and Russia and the US make up, and China and the US are best friends, and suddenly everything's booming. You'd wake up and say, yeah, it's possible. But I could tell you now that gold and silver would still be giving you those returns. Would it be a little bit slower? Yes. But this isn't about 1 year, 2 years, 3 years. This is about 5, 10, 15, 20, 30 years.
And the scary thing is 20 years we're talking about, immediately my mind goes, oh, the 1980s. It was 2005. And the nice thing about 20 years is it does give you those periods of slow growth, maybe even a little bit of decline. And then you do have these periods where there's the big booms. And taking it over a longer period, like 20 years, gives you both of those. And that's all factored in.
Yeah. Just, Willem, thanks for your time today. I think it's been a great conversation. But any final thoughts?
I think we've said it all, Deon.
Yeah, I don't think we could go on more about it. It's important. Be aware. There, I know in one of the episodes I got very, very serious about these imminent market recessions slash depressions, because I do fundamentally believe that the current environment shows that there has to be this reset of some sort. Do we know what it is? I don't think even some of the most prized investors actually really understand what that is. They know it's there. They can understand that it's there. The fundamentals show that something is brewing. Do we know how it's going to play out? We live in a world where information is exchanged at the speed of light. Light of speed of light.
Speed of light. That's the one. That's the one. Literally.
Yes, and again, that's the thing is, so a 1929 depression, which was a world that was a little bit separated. What happened in America did affect the rest of the world, but it took a lot longer to happen. Is it because we are so integrated globally that we could recover a lot quicker, or the converse, that we actually even suffer further? Because it's like with COVID. It happened in China, and within months or weeks, it spread across the globe. And it was the first time in decades where airplanes were not flying and so on. And the world actually started to get healthier, all the natural world. And again, these things can happen. We don't know.
Yeah, it's we will have to see what the impact of something like that would be. You actually summed it up nicely. Is it going to heal so much faster because the world is so interconnected, or is it going to be so much worse because of that? It's an interesting question. But yeah, I think that's a good place to end off on, a bit of a head scratcher for next time. And if you enjoyed the episode, leave a like, and if you haven't done so, be sure to subscribe, and we'll see you in the next one.
Bye bye.